In this video, I will be going over the complete guide to understanding and applying the Fibonacci ratios for your trading. The Fibonacci ratios are a very powerful tool that can help you in identifying and pinpointing market reversals with ease. But like most of the trading indicators, you should never use Fibonacci alone for your trading. In this video, we will first understand the basics of Fibonacci, and then we will proceed to advanced trading strategies using the Fibonacci ratios. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, we need to understand what Fibonacci ratios are. Fibonacci ratios origin from the Fibonacci number series. The Fibonacci numbers were created by an Italian mathematician named Leonardo Pisano. The numbers start from 0, and then they keep on adding the values of the previous two numbers in the sequence. For example, 0 plus 1 is equal to 1. Then 1 plus 1 equals 2. 1 plus 2 equals 3. 2 plus 3 equals 5, and so on. Any given Fibonacci number is the sum of the previous two Fibonacci numbers. The reason why these numbers are important is because they are seen in various aspects of the universe. Ancient architecture, petals on flowers, the shape of our faces and body, are all in some way associated with Fibonacci. Therefore, the advocates of Fibonacci state that the prices of any assets might also be moving in relation to Fibonacci. If you calculate, you will find that any given number in the Fibonacci series is 1.618 times the previous number. Therefore, the number 1.618 is called as the golden ratio. Now let's understand how we can apply the Fibonacci numbers in our trading. If you have been trading for a while, you will already know that the price of any asset does not move in a straight line. The price always moves in a zigzag fashion. Every time the price makes a huge move, there is always a pullback that follows. As a trader, we want to catch these huge impulsive moves. Therefore, we try to enter a long position at the end of this pullback to capture this huge up move. The problem is how we know that the pullback is over and the price is due for an up move. This is where the Fibonacci retracement tool will help us. When the price is in an uptrend, first we see that it makes a huge up move. Then, we see a small down move. This down move is essentially a pullback. The Fibonacci retracement tool will help us in finding potential areas where the price might find support during this pullback. On the other hand, in a downtrend, we see the price makes a massive down move. Then we see a pullback, which is this up move. The Fibonacci retracement tool will help us in identifying potential areas of resistance where the pullback might come to an end, and the price might start another down move. In most of the charting platforms, you will find a lot of levels on the retracement tools. But most of these levels are useless. Personally, I only use the 38.2, 50, and 61.8 levels. I suggest you to remove all the other levels from your tool. Now, to use the retracement tool, we first need to correctly plot the retracement tool. When the price is in an uptrend, we first need to identify the most recent major swing low on the chart. For instance, on this chart, this is the major swing low. Then we need to identify a major swing high, which is this point. Now, we select the retracement tool and plot it from the low of the swing low to the high of the swing high. We want to make sure that we plot the tool from the low to the high. The three lines that we get in the middle are the Fibonacci retracement levels. They are 38.2, 50, and 61.8% of the entire move. In an uptrend, the price will find support at these levels. As you can see, the price found support exactly at the 61.8 level in this example. Similarly, in a downtrend we will reverse the process. First, we need to identify the recent swing high. On this chart, this is the most recent swing high. Then we will identify the most recent swing low on the chart, which is this point. Now, we will draw the retracement tool starting from the high of the swing high to the low of the swing low. Again, you will start from the swing high and end at the swing low. The three lines that we get are the Fibonacci retracement levels. Now, because the price is in a downtrend, we expect the Fibonacci levels to act as a point of resistance. And as you can see, the price found resistance at the 38.2 level and immediately reversed downwards. A pro tip to note here is that, if the price is in a very strong trend, the price will often respect the 38.2% level and will rarely go beyond it. This is because, in a strong directional market, the pullbacks of the trend are very shallow. On the other hand, when the trend starts to mature, the pullback will often find support at 50 and 61.8% levels. In most trends, the price will tend to respect the 50 and 61.8 levels. The 38.2% level will only be used in very strong trends. So this was the theoretical part of the Fibonacci trading. Now let's learn how to use the Fibonacci retracement tool to identify and trade the markets. First, let's understand the basic frameworks of the strategy. The first step is to identify the trend. This strategy is a trend-following strategy. Therefore, we will first identify the trend, and we will only trade in the direction of the trend. The second step is to identify the recent swing high and swing low. On this chart, the swing high and swing low are these points. Once we have identified the swing points, we will plot the Fibonacci retracement tool. The retracement tool will provide us with price levels that will help us in predicting the end of the pullback. Now, when the pullback reaches these price levels, we will look for further confirmation to pull the trigger and enter the trade. There are a lot of ways in which you can look for confirmation. In this particular video, I will share two confirmations that you can use with the Fibonacci tool. So, the first confirmation is a simple moving average. They are a very simple yet powerful tool that can help us in identifying high probability trades. Moving average acts as a dynamic level of support and resistance. It also helps us in identifying the trend. Now let's see how we can compile the moving average with the Fibonacci retracement tool. Look at this chart. Here, the blue line is a simple 50-period moving average. We can use different moving averages for different trends, but for the sake of this video, we will stick to the 50-period moving average. So, here we see that the price has been trading above the 50 moving average for the most part. The moving average is also sloped upwards. This shows that the price is in a strong uptrend. Now, our goal is to trade in the direction of the trend. So we will only look for buying opportunities. Now, we see this up move, and we mark the swing low and swing high of this move. Then we stretch our Fibonacci retracement tool from the swing low to the swing high. Now, when the price makes a pullback, we expect the price to find support at these three retracement levels. At this point, we do not know exactly which level will provide support to the price, but we know that the price will reverse from one of these levels. Another point to note here is that we already know that the moving average also provides support to the price in an uptrend. So on this chart, we can clearly see that the 38.2 retracement level coincides with the 50 moving average. Therefore, we can say that there is a high probability that the price will find support at the 38.2 retracement level. There is a confluence between the 50 moving average and the retracement levels. Therefore, this adds a confirmation to our existing bias. So we will look to enter when the price reaches the 38.2% level. A logical place to set our stop loss will be the level below our entry point. that is the 50% level. We can place our targets at the near-term highs. And as you can see, the price consolidated near our entry point for some candles, but it eventually achieved our target. Now let's look at a sell trade. On this chart, we can clearly see that the price was trading below the 50-period moving average. The moving average was also sloped downwards. Therefore, we can say that the price is in a downtrend. Now, in a downtrend, we will only look for selling opportunities. If we look closely, we see this impulsive move downwards. So we will identify the swing high and the swing low of the move, and plot the retracement tool starting from the swing high to the swing low. When the price starts to make a pullback, we know that the price will find resistance at one of these levels and start another down move. But we cannot simply place a trade on the basis of the retracement tool alone. We need further confirmation. When the pullback develops further, we see that the 50-period moving average coincides with the 50% retracement level. If you remember, we established earlier that the 50-period moving average also acts as a level of support and resistance. Since we are in a downtrend, we expect the 50 moving average to provide resistance to the price. So, when the price touches the 50 retracement level and the moving average, we expect sellers to come in and take the prices lower. The retracement tool and the moving average coincide at the same level, which provides confirmation to the trade. So we can enter on this candle. We can place our stop loss above the 61.8 level, and we can target the previous lows. And as you can see, the price made a strong down move after our entry. Now let's look at the second confirmation, which is the support and resistance. Support and resistance are pretty simple elements of technical analysis. A support level is a price level where we expect the buyers to come in and take the prices higher. On the other hand, a resistance is a price level where we expect the sellers to come in and take the prices lower. An important point to note here is that the support and resistance have a swapping property. So, if the price breaks above a resistance level, then that level will turn into support. Now let's use the conventional support and resistance levels to add confirmation to our trading. For instance, look at this chart. Here we see that the price was in an uptrend as it was making huge moves upwards. So we are looking for buying opportunities only. But first, we see that the price made a strong move here, and then, it found resistance around this price area for 3 times. Therefore, we identify this price level as a resistance level. Finally, on the 4th attempt, the price actually breaks above the resistance and plots a new high. Therefore, this resistance level has now become a support level. Now, if we look at this up move, we can plot the retracement by connecting the swing low and swing high of this move. Here, we can see that the 50% level coincides with the support level. This is an excellent confluence of the retracement levels and support. Therefore, we can place a buy trade when the price touches the 50 retracement level. We can keep our stop loss below the 61.8 level, and we can place our targets near the most recent swing highs. And as you can see, the price gave us a good up move after our entry. An important point to note here is that you don't need both the confirmations to validate a setup. You can make use of any one confirmation. But when you get both confirmations on the same setup, then that becomes a high probability setup. On such setups, I tend to increase my position size and I risk more than usual, because I know that the chances of failure on such trades are very less. For instance, look at this chart. Here, we see that the price made this up move. Then, it found resistance and made a pullback. So we marked this level as a level of resistance. Subsequently, it broke the resistance level and it made another up move. Now, the resistance has become a support. When the price starts to retrace here, we identify this up move, and we plot the Fibonacci retracement tool over it. We can see that the 61.8% level coincides with the support level, as well as the 50-period moving average. So, we have triple confirmation on this setup. The retracement level, moving average and the support level all coincide around the same price area. This indicates that there is a high probability that the price will reverse upwards upon reaching this area. So we enter as soon as the price touches the 61.8 level. We can keep our stop loss a few ticks below the moving average, and we can target the most recent highs. And as you can see, the price achieved our targets within the next 3 candles. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.